What are stocks? A stock market is a place where people buy and sell stocks. If you own a stock, you actually own a piece of that company. For example, if you own a share of Starbucks stock, congratulations, you are a part owner of Starbucks. But how do you buy that stock in the first place? Those happen on any one of many sites, both physical and virtual, that are known as exchanges. The two best-known exchanges in the US are the New York Stock Exchange and the NASDAQ, but there are also 14 others that handle stocks. When people say things like the stock market was up/down today, they're referring to the stock market as a single entity. They are talking about how all of the stocks are doing. Why do people invest in stocks? The primary reason that investors own stock is to earn a return on their investment. That return generally comes in two possible ways. The stock's price appreciates, which means it goes up. You can then sell the stock for a profit if you'd like. The stock pays dividends. Not all stocks pay dividends, but many do. Dividends are payments made to shareholders out of the company's revenue, and they are typically paid quarterly. How does the stock market work? Public companies rely on the market to raise capital and look to their stock price for information about what investors believe about their business and prospects. Ronan says, meanwhile, investors rely on the market for investment opportunities to allocate their capital. The idea of a stock market is to align the interests of the entire trading ecosystem. From public companies to investors to brokers to exchanges, he says, ideally, stock markets allow the investing public to participate in the growth and development of enterprises engaged in all the different sectors of the economy. For investors, the stock market works like an auction, where buyers place bids and sellers offer asking prices for shares of stock. When the bid equals the ask, the trade occurs. The difference between what buyers are willing to pay and sellers are willing to accept is called the bid-ask spread. The smaller bid-ask spread indicates a more liquid or easy-traded security. A stock price represents what the cumulative market of buyers and sellers consider its value to be. And with everything in the economy, it's largely dictated by supply and demand. When there are more sellers trying to offload their stock than buyers interested in purchasing, the price falls. If prices on all or more stocks drop significantly and suddenly, a stock market crash occurs. The most recognized means of making money in the stock market is by selling stock for more than you bought it. This is called capital appreciation. If you buy a share of Apple for $200 and sell it for $250, you've made $50 in capital gains. But to realize your gains, you have to sell your shares. So while you've made $50, you can no longer participate in any future growth or payments to shareholders that Apple may make. Another way to make money in the stock market is through dividends. Dividends are payments companies make to their shareholders, usually on a quarterly basis. As long as you hold Apple stock, you are entitled to any dividends it pays. You can take those dividends as a cash payment or reinvest them to buy more shares of Apple and increase your holding, which will earn you more dividends in the next round of payments since they're paid on a per-share basis. Many investors make money in the stock market simply by investing in companies that pay regular and increasing dividends. Note that not all companies pay dividends, and even those that do have no obligation to continue, like the company bonus, dividends are not guaranteed. Many long-term investors hold on to stocks for years without frequently buying or selling. And while they see those stocks fluctuate over time, their overall portfolio goes up in value over the long term. These investors often own stocks through mutual funds or index funds, which pool many investments together.